So this is chapter 1, problem number 36, and these are similar to your homework problems. I don't work problems identical to your homework, but again, just trying to show you some examples and give you some idea of the terminology that's used. And so we're given some information, and we're told that this taxpayer has $400,000 of taxable income. And it's important that you see the word taxable there. If it was gross income, we would have to deduct the standard deduction or itemize, but it's not. It's already been done for us. So we know it's taxable. And then there's $2,000 of bond interest or interest on a New York bond. That is not taxable. The federal tax owed is $46,628.50 plus, and I'm taking this from the chart in the back of the book, 400,000 minus 204,100 times 35%. And so we add these two together to get our total tax, which is 115,193.50 or 115,194. So those tax schedules, again, are in Appendix D, and I'm going to flip over there right now just so I can make sure that I didn't use these actually. So we've got a single taxpayer, and if they make 204 to 510, 300, we take 46,628.50 plus 35% of the excess over 204, 100. And so that's how you calculate that, and you have to make sure you're using the tax rate schedule for single. So now we're going to look at problem number 37, which is based on the same facts. And I've mentioned, I think in the intro video, that people will often ask you, what tax rate will I be taxed at? Well, it depends. And so there's terminology that we use in tax, and one of those is called a marginal tax rate. And so what we're looking at is if this person earns an additional $15,000, what is the marginal tax rate? In other words, what would she be taxed at? So if this person just said, hey, if I make $15,000, what am I taxed at? Then you might look back at Appendix D or in your chart that you have in your office or on your phone, and you say, oh, you're single, so if you make $15,000, it's going to be $970 plus 12% of $15,000 minus $9,700. But that's not right. It's an additional. So what we have to do there is we have to look at where this person is sitting on the tax rate schedule. And oftentimes we can just look at it and we can say, oh, you're between the 204.1 and the 510.3. If you make an extra $15,000, it's not going to bump you into the next tax bracket. So your marginal tax is 35%. That one's pretty easy to see in the chart. Make sure you look at that so you'll know what I'm talking about. But the other thing we can do is we can do a marginal tax rate calculation, which is the change in tax divided by the change in taxable income. So the first thing we have to do is calculate what the new tax would be. And the new tax would be $120,444, and the new taxable income would be $415. And so we can actually do a calculation, and Excel doesn't seem to like me today, so we'll see if I can get this to work. A change in tax divided by the change in taxable income. Oh, I want that first, sorry. 35%. So again, if they jump out of that next tax bracket, then you do have to do the calculation. But if it's just an additional amount that keeps them in that same range, then it's pretty easy to look at the tax rate schedule. And so sometimes what I'll say is, well, you're making $400,000 right now. It's going to take a taxable income. You can make another, 100 and I'd have to look back at the schedule, 110,300, and only pay 35% on that. In other words, you're not going to jump up to the 37% until you make that additional amount. I actually skipped this on problem 36 because I wanted to jump into this first before we talked about the other part of chapter 36. But some of the other things, and if you have good software, it'll print this out for you, which is good. Sometimes, though, your clients will ask you, what does this mean? Your average tax is your total tax divided by your taxable income. And so for this one, it's our total tax divided by our taxable income. And so our average tax rate is 29%, or if we want to round up, 28.8%. And you're like, well, wait, why is my marginal 35 up here? Well, it's because part of your income was taxed at a lower rate. So on average, you paid a tax of 28.8%, which is a really nice way to help people understand their taxes. The effective tax rate is your total tax divided by your total income. Now, I don't really like the way this particular question is worded because we don't know what gross income is, but we do know total tax, and we do know that total income includes that $2,000. Whoops. And so it's 28.66% is our our effective tax rate. And marginal, again, before we get to problem 37, marginal we can see is going to be 35%. So again, some of the terminology that we use in chapter 1 that go right along with your homework problems. You have another question related to bonds, and so we're talking about a City of Heflin bond. It's one of your homework problems. And so I'm going to go ahead and look over at, make sure I get one that's similar so I can help you understand that. I'm going to go ahead and look at problem number 43. I believe your homework is problem number 42. So it won't be the same, but it'll be similar. And almost always these homework problems, if you'll look, there'll be an example in the textbook that's almost identical. So in this one, Hugh has a choice between investing in a City of Heflin bond at 6%, so a city bond at 6%, or a sure thing bond, which is private, and it's 9%. And assuming that both bonds have the same non-tax characteristics and that Hugh has a 40% marginal tax rate, so marginal tax rate, again, information we have to have before we can give anyone advice on what bonds to buy. They said, what bond should he invest? So what we want to look at is our after-tax rate of return for both of these. So we have an after-tax rate of return. On the sure thing bond, his after-tax rate of return is going to be 5.4%. Now, why is that? So we're going to pay tax on the 9%. And so what we're going to do is take 9%, and I'm just going to show you the calculation, times 9% minus 9% times 0.40%. Now the reason is he's in a 40% marginal tax rate. So he is going to get 9% interest on that bond, but he's going to have to pay tax on that of 40%. So he's really, the other way to look at this is he's getting 60% of it after tax. So that would give you 5.4%. However, his after tax on the city bond, because he doesn't have to pay tax on that, is 6. So he should actually choose the city bond, even though the sure thing bond pays more. Now, in what world would it be better for him to buy the sure thing bond? Well, if he's at a lower tax rate. So if he's sitting at 10%, then he's way better off doing the sure thing. So we have to know what that marginal tax rate is in order to answer a question when someone asks us about their taxes. Another homework problem that you have has to do with horizontal equity and vertical equity. And I actually, in one of my videos, kind of gave some of that away. But vertical equity and horizontal equity is actually really easy to understand. Horizontal is where two taxpayers in similar situations pay the same tax. Vertical tells us that we're looking at a progressive, well, let's see, how do I say it? To be vertically equitable, you should pay more in tax dollars when you earn more taxable income. And so we want to look at that very closely. And again, there's some great examples for you. I'm trying to find one on vertical that I can work for you. I may have assigned them all to you, but I know there's a good example in the book. So there's several horizontals. So I'll tell you what, let's your homework is problem number 51. I'm sorry, number 52, which uses information from 51. And it asks what the minimum tax that Pedro would be required to pay in order for the tax structure to be vertically equitable. So we've got May earning $10,000, paying $600, Pedro earning $20,000, paying $1,500, and Vanita earning $10,000. And it says that to be vertically equitable, Pedro should pay a tax rate higher than 6%, and that's because May is paying 6%, earning $10,000. So if we go vertically equitable, a 6% tax rate on Pedro's $20,000 taxable income would result in a $1,200 tax. So he needs to pay more than $1,200 for it to be vertically equitable. And so you can kind of work through that. I mean, I basically gave you the answer to the problem, but there's a couple more that you have to work so you can get a good understanding. Horizontal, I think, is very easy to understand. Vertical is a little bit harder, but again, they're both very important to understand because you have to explain this to your clients, how those tax structures work, and this is a really good way to explain it.